On the downside, oil can go as low as $40 a barrel and we will still profit. That's the break-even price. And for historical context, oil hasn't been that low except for 8 months during COVID when everything was shut down, so no one was going anywhere, and 4 months during 2016. Hey everyone, Keshav Kolur here, founder and principal of Clive Capital. And here with me today, I have my partner, John Lai,
Hi, everyone.
and our partner, Courtney Moeller.
Hey, and I recognize some names on here. Awesome.
Yeah. Some of you have already soft committed in the portal. We're really excited to have you on for this opportunity. This is going to be a 30-minute, 40-minute presentation, and we'll leave time at the end for Q&A. So welcome to Iron Horse Energy Fund 2. This is going to be our fourth partnership with Courtney and with DW. Oil and gas is our investors' favorite asset class. Out of the roughly $11 million that we manage, $5 million of it is allocated to oil and gas just in the last year. Folks love it because of the tax benefits and the cash flow, which we'll cover in this webinar, and especially in this geopolitical economic environment, the macroeconomics really support an oil and gas investment as well. So this is going to be a $10 million diversified oil and gas fund for accredited investors only. And we do close June 30th, 2026. So in about a month and a half, hard close. So make sure you get your money into us by then. And the legal documents, accreditation, all of that. So if you have questions, feel free to throw them in the Q&A. We'll hopefully address them along the way. And if not, we will get to them as they come up. So let's get started. And Courtney, always, please feel free to jump in with anything, any additional color. So quick disclaimer for those listening at home, we're not investment, tax, financial, legal, or any such advisors. This is purely for educational purposes only. So please do consult your own such advisors in your life before making any such decisions. And all investments come with risk, including oil and gas. And so just be mindful of that as well. So this is our...
Keshav,
Yep.
are you showing your screen? Because we don't see anything. I don't see
Oh,
it.
that's fun. Okay. So let me do that. Might be important, maybe. Okay.
I'm sure everybody would love to just look at us the entire time while we talk.
Yeah. Okay, what do you all see here?
We
Okay.
see with
The
presenter
notes.
notes. Yeah,
Yep.
so show
Okay,
the other
let's
one.
try that again. Desktop 2. Oh, here we go. There's 4 different options for PowerPoint. Are we good
It's
now?
good. Yeah,
Okay.
that looks
Thank
good.
you. Thank you. This is why we need partners. Okay. So table of contents, so now that everyone can see what we're looking at here. So this is everything that we're going to run through, again, in 30 minutes. So let's get this show on the road. So at a high level, this is going to be a $10 million diversified oil and gas fund for accredited investors only. We're going to be acquiring non-operating working interests, NOI for short, in the top basins in the US. And we'll cover more what that is as well. Fund 1, we closed with our partners and we raised $31.5 million in December of 2025. And we helped our investors offset or reduce their taxable income by about $30 million, which is pretty huge. So Fund 2 is going to follow the same playbook, the same underwriting, the same structure, and we're just running it back. So what can you expect? You can expect monthly passive income because of the direct participation in these wells. Roughly 90% K1 loss. These are your tax benefits, your deductions in year 1. So every $100,000 invested, you'll get roughly a $90,000 tax deduction, and you can use that to offset your W-2, active, passive, capital gains types of income. We're not CPAs, so always check with your CPA. But a $90,000 deduction at the tax bracket that, if you're listening to this, that you probably are at, probably yields a $30,000 to $35,000 tax bill savings. Each state has its own regulations, so I won't get into that. But in general, every $100,000 invested, you can expect to save $30,000 to $35,000 in taxes, roughly, just in year one. A diversified portfolio. So we're going to be diversifying the fund across 20 to 30 wells. The last fund was 40 wells. So that should give you an idea of the scale. Inflation resistant. Oil is a commodity, and so it tracks inflation. And we're going to be roughly targeting a 20% IRR. That's on the conservative side. Our goal is always to underpromise and overdeliver, but as oil is very volatile, as we've seen over the last few months. But we'll mention how we're being conservative, what are the risks are, how we're mitigating the risks. We're going to get into all of that. And overall, we're targeting a 2 to 3x equity multiple, meaning $100,000 invested, you're going to get roughly $200,000 to $300,000 back. And that's based on oil being at $72 per barrel and each well having, on average, 650,000 barrels of oil and 8 million, is it 8 million cubic feet of natural gas?
Yes. Yeah,
Okay.
you're right.
Okay. So why are energy investments especially important today? The tax benefits are evergreen, but why does today's environment make it very attractive? So persistent global demand over the last few years, last decade, we know that renewables have been generating more and more energy, but our demand as a civilization for energy continues to outpace that. So oil and natural gas and other fossil fuels aren't going anywhere. Years of supply underinvestment. Go ahead, Courtney.
No, I was just going to say, always get asked a lot, are electric vehicles going to eliminate the need for oil? And I think we have seen how very dependent we are on oil just in this last few months. And that demand has grown. And we are seeing that in our gas prices, our electric bills. We're going to see it in our food costs. It's going to trickle down into everything.
Yeah. And even to go renewable, fossil fuels are required to make a lot of the components that go into windmills and solar panels, etc. The show Landman does a great job of explaining this, that even if you want to go renewable, it's not going to happen without fossil fuels. And not only that, but more than 6,000 daily products have byproducts of fossil fuels as well. You'd have to replace so many manufacturing lines and product design and things like that. So it's not going anywhere anytime soon in our lifetime, I would say. Years of supply underinvestment. So over the last decade, there's been an underinvestment in upstream exploration. Capital's been really conservative in terms of just drilling in the areas that they know are proven that can produce oil. And so the global spare capacity is very thin, which we saw immediately get disrupted when the war broke out in the Middle East towards the end of February. Institutional capital returning, private equity is continuing to pile into US oil and gas. Sovereign foreign wealth funds are continuing to do hedge funds. So big money continues to move into this sector. And lastly, the tax benefits that we all know and love. So 85 to 95% year one deduction and depletion allowance as well. Depletion allowance is where for the lifetime of the investment, the first 15% of income is tax-free. So if you received $100, only 85 of those dollars are taxed. So just continuing on that theme, we know that the Strait of Hormuz is disrupted because of the oil in the Middle East, the war in the Middle East, and that West Texas Intermediate is trading roughly around, at least at the time when we put this together, $95 to $119. I checked before, it's $80 now, but I don't know, Courtney, if you've seen what data
Oh, it's
Brent.
sitting at 102 today.
Oh, okay. I think I was looking at WTI, maybe. Okay.
Yeah, WTI is 102 today. In fact, I can tell you exactly where it's sitting at. This slide has been so difficult to keep maintained. I feel we just keep slapping back and forth with different headlines. It's sitting at $100.82 right now.
Yeah. And lastly, the energy, thank you for that. The US Energy Information Administration raised the 2026 forecast from, I think it was 50 something dollars a barrel. We'll see it here pretty soon. And now it's more like $74 a barrel. There you go at the end. And global supply, it's 20% that's disrupted through the Strait of Hormuz.
And I think that's probably even changed now. The longer the strait closure continues, the more disruptive it is. I think a lot of people don't realize that we have reached a point in time where you can't just open the strait back up and everything goes back to normal. There is a lot of infrastructure that has been destroyed over in the Middle East, the LNG pipelines, a lot of things they can't just turn back on. And I think the other thing people don't realize is we've got 100 million barrels of oil floating around in the strait on these tankers, but there hasn't been any other oil that's coming behind it. They've had to shut in a lot of these wells and turn them off because there's nowhere to send that oil. And that's actually very disruptive on its own because they have low pressure wells in a lot of the areas, especially in Iran. And if you turn those off, you can't just turn them back on. And they're estimating at a minimum of 10% of those wells will never come back online again. So a lot of issues, a lot of things. And actually, I think that EIA revision probably will get revised again. I think they're expecting no less than $75 all the way through December of 2027.
And again, just for reference, our model is based on $72 oil. So the Strait of Hormuz is closed for the last 2.5 months now. Over 14 million barrels of oil every single day pass through that narrow strip of maritime or sea. And the US is one of the big beneficiaries of that. Outside of the Middle East, you have Venezuela, you have the US, you have Nigeria, and you have Russia that are major oil producers. The US stands to benefit the most from this disruption. So you'll see that the US is poised to do very well. And that's why we're going to be investing into these wells in the Permian, which is West Texas, where that's what most people are familiar with when they think of oil and gas. The Bakken, which is North Dakota, the Eagle Ford, which is South Texas, the Niobrara, which is Colorado, Wyoming, Nebraska, and the Anadarko, which is Oklahoma and North Texas. And lastly, underwriting. We underwrite our acquisitions at $65 per barrel. That's different from the projections that we make, which is at $72 a barrel. So you'll see that there's plenty of cushion because, as Courtney said, we're currently sitting at not even $90. West Texas Intermediate is at $100. And on the downside, oil can go as low as $40 a barrel, and we will still profit. That's the break-even price. And for historical context, oil hasn't been that low except for 8 months during COVID when everything was shut down, so no one was going anywhere, and 4 months during 2016. And that's when the world was getting used to the shale revolution and this new surge of oil and gas, that new abundance in the market, basically.
Hey, question came in. Do we not get any tax savings from year 2 onward? And either if Courtney or Keshav, you want to address year 1 versus year 2 onward.
Yeah, I would say there's very minimal, if almost none, tax benefits in year 2.
Yeah, the ongoing tax benefit is the depletion allowance. And what that is, the first 15% of your income from the oil and gas production is tax-free every year for the life of the deal.
Yep. But that huge 90% upfront deduction, that's just one time.
Correct.
Yeah. Okay. I added this slide here just because I feel like the last slide, there's a lot to cover here in terms of why there's so many reasons to be bullish on oil and gas. Number one, I would say, is the AI power gap. A lot of folks on here are from the tech industry, our fellow Amazonians, MetaMates, Googlers, et cetera. And you know that this huge AI boom that's happening, the data center power demand is unprecedented. And some of it can be done with renewables, yes, but a lot of it will have to be powered with natural gas. So there are estimates that the US alone will need an additional 47 to 105 billion cubic meters of natural gas to keep these data centers online. Second, this goes to Courtney's point that even if the Iran war ends tomorrow and there's peace among worlds and everything, the market cannot simply reset to 2025 prices. There's been too much global supply disruption that has already happened because of the strait closure and damaged infrastructure. So these refinery repairs can take anywhere between 3 months up to 5 years in the worst case. Even if you have to build a new one from scratch, that's going to take time as well. And on top of that, 400 million barrels of strategic reserves have already been drained as well to cushion the immediate blow. So those reserves are going to have to be refilled. and you're going to have to circulate oil around the world again, rebuild your infrastructure, and that's going to take time.
And I'll add to that, the world has less than 60 days of strategic reserves left before that's completely depleted. And it's actually almost concerning, but it puts us in a very positive strategic position as oil and gas investors.
Yeah. I know a lot of you might have read that oil, especially last year, the fear mongering in the news from big banks that oil is going to sit at $40 a barrel or $30 a barrel. And we'll look at where we are now. A lot of those assumptions are very simple. Some might even say that they were made on purpose to mislead retail investors. So it's important to keep in mind these fundamentals of why we invest. And in addition to the conflict in the Middle East, there's the Russia-Ukraine war as well, where Ukraine is constantly blowing up Russian oil infrastructure and pipelines. And that's obviously putting additional pressure on prices. And the last one is a more nuanced take that Courtney and I have chatted about here, where dated Brent is different from ICE Brent. So ICE Brent you can think of as the futures contract, what you will typically see on financial markets, what the price of oil is. Dated Brent is what people are actually paying in the real world to take deliveries of oil today. And there's a $20 to $30 premium for dated Brent, what people are paying in the real world today, versus what the markets are telling you. And that's because, one, financial markets aren't always the best indicators of reality, as we're starting to see. And number two is that right now they're hopeful that there will be a quick resolution to the war. So
Yeah, and just to give y'all a little more information, you have Brent and then you have WTI. Brent crude is oil that is sold over in the European area, and WTI is the pricing here in the United States. And typically there's only about a $2 to $3 difference between the WTI and Brent, and there's a pretty big gap right now. And then the gap he's also talking about is what the paper markets are pricing oil at versus what oil is actually being sold at. And some of those barrels are all being sold all the way up to $175. And so those will eventually converge and become the same, but typically the paper markets price up to the actual market. So
yeah, financial markets can deceive and try to ignore
well,
reality.
financial market is still pricing this like we can reopen the strait and it's going to go back to normal, and that's what's happening.
Yeah. So that's just something to keep in mind as well as you track the daily price, is that it's not 100% accurate. And before we move on from here, what we'll say also is this is probably the last time that we can take advantage of buying low and selling high before these higher oil prices work their way into our acquisition prices as well. So I'd say that's another reason that now is a great time. Later in the year will be good too, but go ahead, Courtney.
I hope so. I'm glad you brought that up. It's not something I've really talked about. Typically, when you have really great markets, that does trickle into the acquisition prices. I'm actually very concerned about our potential of our Q4 fund, because if we can't acquire assets that pencil out and make sense, just like any other asset class, it will prohibit us from doing our Q4 fund. So right now, we haven't seen that happen just yet. We still have great acquisition prices, but that could change later in the year.
Yeah. So I would say it's better to get in now and take advantage when we know what we can lock in before prices potentially increase here. And there's less upside for us to capture.
Another question came in. It sounds like it's similar to a previous question. Does the 20% IRR take into account taxes on the 85% of the cash flow received from year two, excluding depletion allowance?
I do not believe so. We don't ever write any of the tax benefits into our returns. I know for sure the IRRs and everything at the initial part are not, so I'm sure Landon didn't write that in. I don't like to have tax benefits included on returns because everybody's tax situation is different. People are in different tax brackets and it impacts their situation differently. So we do have it set up to where you can see what the returns look like with and without the tax benefits. Actually, now that we just talked that through, it does not.
Yeah. Okay, so our strategy, now we've talked about why it makes sense. So our strategy here is the same that it's been always. So it's to partner with the best companies, both public and private, with proven track records. And for two reasons. Number one, more experience is better. We know that it's not their first rodeo. And number two, we know that their break-even price of oil is going to be lower because their economies of scale benefit us. So every barrel of oil that they produce, they get to spread out their expenses amongst all of them. So at most, the break-even price of the companies that we invest with is $40 a barrel, meaning oil can go as low as $40 a barrel and we will still profit.
And something else that I think that is important to add into here, these guys are funding, they have almost all the skin in the game on these projects. When we're looking at let's say it's $100 million project, these major operators, EOG and Continental Resources, Exxon, they don't need our money to do these projects. We go in and buy a very small 2, 5, 10% interest, and we come in with our very small amount, but these companies typically own anywhere from 60 to 90% of the deal, which means they're funding 50 to 90 million of that 100 million. So because they have the majority of the skin in the game, they're going to squeeze every drop of oil out of these that we can, and we're just reaping the benefits from that.
Yeah. And I would say the other benefit of going with a large, or one of the disadvantages of going with a smaller company, there's plenty of smaller companies out there that will reach out to folks to invest into oil and gas and they'll pitch the tax benefits. But those smaller companies actually need your money. That's why they're pitching to you. And number two, their break-even price of oil is higher. Typically, it could even be as high as $55, $60 a barrel. And so what we've seen over the last 2 years when oil prices were really low is that a lot of these smaller companies went out of business because they just couldn't weather that.
Yeah, and they stopped having distributions, and just not only did they stop distributions, but they were having monthly capital calls to cover those lease operating expenses because some of them are actually $65 break-even prices, which is very high.
Yeah, even worse. So location matters as well as it does with real estate. So these are the 5 basins that we invest in, which I mentioned earlier, what states that they're located in. So location. We'll never drill in Tennessee or Kentucky, or even though they might have oil, we'd rather drill in the best places. And lastly, it's diversification amongst various wells, various basins, and multiple companies. And below here, we've listed some of the companies that we've worked with in the past and some of the potential ones that we might work with on this fund as well. So our underwriting criteria, number one is the major operators, proven production areas. And number two, max break-even oil price of $40 a barrel, 90% estimated K1 tax loss, the deductions in year one. Underwriting our acquisitions at $65 oil and $3.50 per million cubic foot of natural gas, and at most a 10% ownership stake in each well, somewhere between 2 to 10 usually, for the diversification. So everyone's favorite part, the tax benefits, has the potential to offset W-2 income, active income, passive income, capital gains. And that comes from 2 different areas. You have intangible drilling costs, which are your non-recoverable expenses like water, fuel, chemicals, labor, etc. And that's the majority of the cost of drilling the well. Those are one-time exhausted. There's no reclaiming labor, for example, once you pay people to drill the well. And it's intangible because you can't really touch it. Tangible drilling costs, you can touch it. So these are your physical drilling equipment, pump jacks, heads, etc. That's deductible as well and depreciated and capitalized over 7 years.
Yeah, and that actually just changed because of the bonus depreciation rules. We're able to take all of it up front, but it's very minimal compared to the IDCs. Let's say 85,000 or 86,000 of your taxes benefits coming from the intangibles. It might be 3,000 that comes from the tangibles. It's very small.
And lastly, the depletion allowance. So as we mentioned earlier, that upfront 90% deduction you only get in year one, but your ongoing tax benefits is the depletion allowance. So 15% of all income for the lifetime of your investment is tax-free. And in Fund 1, which we just closed in December, we were able to $31 million roughly. We were able to get investors a 95.6 K1 loss, meaning every $100,000 invested, they wrote off $95,600 from their taxable income, which is pretty sweet. So at a high level, the last fund that we closed, just because this one's very similar to the last one, we're going to review it a bit here. So $31.5 million, December of 2025. And it was diversified across 40 different wells, 3 basins, and 10 operators, 10 drilling companies. And we listed them here below. Year one tax benefits, which we just covered, and the status is 20 of the 40 wells have already been drilled. 3 are producing. These numbers might be even more up to date. Courtney, I don't know if
They are, yeah. We had 5 the other day, and then I checked our Oklahoma. Almost all of our Oklahoma wells are online and producing, with the exception of, I think, 3, which means I think it's another 18 or 20 more wells that are online. So we have significantly more online, more than half are online and producing. I think almost 3/4 of them are now, which is great.
exciting. And we just sent out our first distribution as well a couple weeks ago for that fund. So now, who are you investing with? So our team's experience collectively is more than 180 deals across 1,200 different wells that it's produced more than 180 million barrels of oil, 750 billion cubic feet of natural gas, and our partners have collectively helped more than 1,100 investors invest. 4 out of the 5 projects that Courtney has worked on over the last 3 years, and I've participated in, I think, 4 out of 5 of them, have been paying monthly distributions in 2025, even when the price declined by 37%. Only one project had to change pumps, and that impacted revenue, but otherwise, even that one is back on track and chugging along now, too. I think the other thing that I'll mention here, no, that's the next slide then. Okay. So risks and mitigation. So we have tax benefits, we have passive income, the macroeconomic environment makes sense, but there's still some risks that come with investing. It's not too good to be true. So one risk is uncertain returns. You don't know how certain wells are going to perform, how much oil, how much natural gas they're going to produce. It's Mother Nature after all, and we can do our best to estimate, but we can't always get it 100% accurate. But we get pretty close. And so that we can mitigate that by diversifying across multiple wells, basins, and operators. So what you'll have is with some wells, they'll underperform. Most of your wells will produce as expected, and then you have a couple of rock stars that offset the underperformance, and that's just the way these things go. Number 2 is the commodity price volatility. As we've seen, oil is all over the place. Natural gas can be all over the place. To mitigate that, we have low break-even oil prices, $40 a barrel, and diversification across multiple basins as well. And the third thing is when we're making projections, we use $72 per barrel of oil. And that's a conservative figure because over the last 5 years, that's what oil has averaged. And that includes when it was climbing back up from the lows of COVID. And the other reason it's conservative is because oil is a commodity, tracks inflation. So even though it was $72 the last 5 years, there's been a lot of inflation over the last 5 years as well. So it should be higher these next 5-7 years. No assurance of commercial production. Basically, what's the risk that we hit a dry well that won't produce any oil? These companies that we're investing with are major companies drilling in these proven basins, and they typically have a 90+% success rate. And in the 1,200 wells that our partners have participated in, only 10 of them have failed to produce. So that's a 99% success rate, roughly. Delays in drilling and operations. So here we are minority equity stakeholders in each of these wells. We don't run the show. As Courtney mentioned, the drilling companies own most of the wells, so it's up to them, the drilling schedule and repairs and things like that. And one way we mitigate against that uncertainty is having a multi-well, multi-company portfolio. And that means that individual delays don't impact us because even if one well is behind schedule, the other 20, 30 wells are chugging along just fine.
Yeah, and this was I just want to throw one more thing in there. This was one of the biggest reasons we moved to the fund model because you're going to have delays, you're going to have repairs that have to happen. Anytime you buy an asset, whether it's a house or a well or a car, there's repairs and maintenance and things that have to be done. we want multiple operators and multiple wells so that if one set of wells they decide, hey, we're gonna push this back for 3 months before we drill, it doesn't impact the entire project. Or if there's a pipeline repair that has to happen, stuff just happens. And so when we have this large diversified fund with multiple operators and multiple wells, and one decides to push drilling back 3 months, it doesn't have a total impact on the entire project.
There were a couple questions that came in. I'll ask a few of those. What does the date of June 30th signify? Is that the date that you expect to raise the 10 million? If so, what if you're unable to raise the same? Also, when does the first distribution start for this fund?
Well,
So go ahead.
yeah, go ahead.
Okay, so June 30th is just that's the last day that we accept capital. Our soft commitments have already vast exceeded that 10 million figure, so we have no doubt in our minds that we can raise it. Even if for whatever reason we can't raise it, we would just deploy however much capital that we raise into diversifying across the multiple wells. And in terms of distributions, we project that they'll start sometime in Q4. We don't have any control over when these distributions start. Our last fund we closed in December, distribution started in May, so roughly a 5-6 month time frame. So that's why we say Q4, but that's nothing that we have control over. And I just want to stress that because it does get stressful after you make your investment of when you're going to start receiving distributions. But the other reason that the fund model helps is because we're able to diversify across multiple wells, one of these companies is going to start distributing early.
Yeah.
And speaking of the amount, why are we raising a smaller fund versus our last fund of 31 million?
Yeah, I'll take this one. So typically I like to do a smaller fund in that the beginning of the year, there's typically less interest in oil and much more interest at the end of the year. Come Q4, everybody's looking for diversification and everything else. We probably should have flip-flopped at this time because right now with oil sitting at $100, everybody wants it. And when we launched this $20 million, $25 million fund, the main Iron Horse one, we had probably 50 million in soft commits for that. So we'll see what that actually ends up looking. Keshav said this OG5 fund that's going into Iron Horse, I'm blown away at the response. It's been pretty incredible. So when we were setting up this model to do a Q2 and a Q4 fund, I had no idea that oil was going to be sitting at $100 at this point in time.
Right.
Yeah, I think one thing that may be confusing about the structure there, Courtney, that you mentioned is the 10 million here is just for our child fund or feeder fund. There are other fund managers as well, other funds, and we will collectively accumulate or pool our capital together to invest into the parent fund. So when we talk
No,
about 31,
OG5, yeah, OG5 was built specifically to invest into Iron Horse 2. We do that for a bunch of different reasons. The minimum investment into Iron Horse is $1 million. So this lets us create a feeder fund that allows smaller investments for our personal investors.
yep.
Next question is, how long is the life of the fund? Were you sure yearly projections for return of the lifetime of the fund?
Yeah, so let's get to these questions. We have another slide coming up that will answer all
Yeah.
these. So
Okay.
people are just really excited. Okay, so now meeting the team. Courtney, if you could give a quick introduction about yourself and your background.
Yes, absolutely. I am originally from West Texas. I grew up in the Permian Basin. My father was a petroleum engineer. My brother drilled oil. My uncle has a well servicing company. My sister drives pipeline out to the rigs. And we have lived and drilled in the United Arab Emirates, in Pakistan, and my father drilled in Indonesia for 20 years. So this is not something that I just decided I wanted to be a part of oil and gas. This is what I was born and raised into my entire life. And this is what I do full time. And my partners, it's the very same. I inherited my dad's oil and gas company in 2011 when he passed away. And the cool thing is a lot of the wells that I have, or some of them in my own portfolio, were wells that were drilled with Exxon and Chevron back in the 70s because my father and some of his friends put together deals and then partnered with these major companies to go and dig these wells. And so we own several thousand mineral acres in the Permian Basin and have continued to drill with companies like ConocoPhillips and other major operators. Like I said, this is not something I just decided to do. It's been something that's been a part of my life and my family's life my entire life.
Thank
And
you, Court.
I don't know if you've got Rick on here, and yes,
He
so
is, yeah. Is
yeah,
Alexis on here? Because if not, I'll have to.
I am not sure if she is
I
or
am
not.
on here. I don't know why it
Okay,
says
I was
Courtney
gonna scold
Moeller.
you. I was gonna scold you for not being here. Okay.
No, I am.
If you could
Oh,
introduce yourself, yeah.
yes, absolutely. Sorry. And it says Courtney Moeller. This is actually Alexis Hildebrand. But, anyways, I am on the investor onboarding deal flow side. And so I just help with everything in the background. And I've been with Courtney for a little over a year now. And so just I'm here if anything is needed as far as investor relation questions and everything else.
And statuses,
And
the well
yeah.
status sheets updated and things like that.
Yeah,
So
just background information, really.
Yeah. Our team will mostly be the point of contact for those who are listening, but if
yes,
anything's above my pay grade, then I'll go bug Alexis and Courtney.
yeah, she's mainly project management.
Yeah.
Yeah.
Okay, so Rick, I don't know, Courtney, if you want to introduce Rick, because I know he's not.
Yeah, Rick is my partner. He is a landman. And I saw that one of the questions on there was, why would these operators sell to you? And they don't. And we don't buy these acquisitions from operators. We typically buy it from individual owners. And what Rick does as a landman, if any of you have seen the show, he goes out and we actually have an entire team of landmen and talk to landowners about acquiring their mineral rights and things like that. That's what actual landmen do, as exciting as the show is. And so we have our team, and Rick is a fantastic guy. We figured out that we were both stationed in San Diego in the Navy at the same time. He was the executive officer on a submarine, and he's done significant work in the Pentagon. And our other partner, Landon, that's on here, is also a retired veteran. He was an Air Force fighter pilot. And so we've got this really great veteran team. And what I love about them is their values and their honesty. And Rick's story is very similar to mine in that his entire family comes from oil and gas also. And he started working on or putting together oil and gas investments in 2008. When he got out of the Navy, he went back to school to become a landman and did that at TCU and has been putting together these deals for almost 20 years now. So he's got significant experience and just a really great, honest, down to earth guy. I'm very grateful for my team.
And next we have, let's see, myself. So as you all know, I'm a fund manager. We've recently crossed $11 million in equity under management, investor capital that we manage, diversified that across now 1,200 apartments, more than 100 single family rental homes, 14 industrial warehouses, and 56 oil and gas wells, and private lending nationwide. So the goal is to help our passive investors, really high earning W-2 folks, mainly from the tech industry, but others as well, with tax benefits, passive income, and great returns. And John.
And for myself, I long time in tech, recently really retired and focused on this, on the deal sourcing side and due diligence, and so focused on just bringing in more deals like this.
So that is your team. So we'll now go into fund terms, which is what a lot of the questions were around earlier. So this is a 506C investment opportunity available to accredited investors only. Our fund, the child fund, is the size is $10 million, and our soft commitments for that have already exceeded more than 10, if not $15 million. Courtney, I don't know if you have the number off the top of your head.
I don't. It's a
Okay.
lot. People have actually, we have a spreadsheet with soft commitments, and then we have actual commitments in the portal of more than 4 million, but well over 10 for the fund itself.
Yeah. And minimum investment here is going to be $100,000. The offering does close June 30th, meaning we need to receive your capital, have your documents signed, all of that by June 30th. The hold period for this opportunity is going to be 7 to 10 years. And we roughly estimate, we'll get to that. Distributions are monthly once they start, which again, we don't have any control over, but it starts sometime in Q4. Estimated return of capital is going to be in 3 years. And so what that might look like is in year one, a 40% return, 40. Year two, 30% return. Year three might be another 30% return. And it continues decreasing from there because it is a depleting resource. And at the end of somewhere between year 7 and 10, once we've depleted enough oil, then we will sell the entire portfolio of wells and exit. Estimated year one K1 loss, 90% of your investment. And estimated target return 1.9x. Again, variable, but that's what we conservatively project. And these are going to be the use of funds. So 85 to 95% for actual project drilling, testing, contingency fund, another 5 to 10% to acquire the leasehold for these projects, and an upfront 3% fee at our fund level for administration, legal, and title. And then I should also mention there's a 10% profit share that's to us as well at the fund level of ongoing profits. So, investment timeline, next steps here. The fund is open right now as we speak. We have about 6 weeks left before it closes. We're going to be spending right now, Courtney and Co., and even a couple months after we close the fund to acquire the assets, the wells. These assets will start producing somewhere between now and Q4. And that's when monthly distributions are going to start. But as we note here at the bottom, operator distribution timing is outside of Iron Horse's direct control. But once it starts, distributions are paid monthly. And the only other thing to keep in mind is in terms of tax returns, we typically get those to you around March, April time of the following years. So white glove service here, monthly progress reports, monthly cash distributions, annual tax documents. Oh, I was already saying that here. Okay. Typically in mid-March of each year, and dedicated investor relations support. So you can always reach out to the Clive Capital team using ir.com, or that's the preferred way. You can always text myself or call me, email as well, for any questions that you have about updates, distributions, taxes, etc. So the investment process, 7 steps: fill out the soft commitment linked below, which will show up here in a bit. Receive access to the data room and marketing materials, which you should all have access to in the portal. Obtain your accreditation letter. I typically recommend that you get it from Parallel Markets. It's free and it takes less than 24 hours to do. Sign the legal documents, fund your investment, sit back and enjoy tax benefits and passive income, and we'll keep you informed of progress through these monthly updates. So if you go here to the link at the bottom, clivecapital.cashflowportal.com, you can log in, see the investment, see all the investment documents in there, and you'll see sample K1s, a guide for CPAs. You will see drilling company profiles, this presentation, the calculator, frequently asked questions, and many more. And if there's any questions that are not covered on there that you come up with, then always feel free to reach out. Any questions from folks? That was our presentation.
There are quite a few.
Okay.
Let's answer the easy ones first. Do we get to use the tax benefits for 2026 tax returns, or is it 2027?
2026.
2026. The next one is, does the return of capital exclude the tax benefits? For example, if we invest 100,000, are the distributions themselves expected to account for 100,000 after 3 years?
Correct. That's distributions only.
Yeah.
Not yet. So even the 20% IRR does not account for tax benefits.
Yeah. Is 40% returns for year one realistic based on last 3 deals?
Yeah, and I can jump in on this. So I would say 2 of the last 3 deals aren't even a year old yet. So that is, and then the third one is the Colorado 3 deal that we've had to take offline for several months while the pumps are getting replaced on that. But there is a write-up in the portal with the track record that shows exactly when each deal was launched, what the returns were, what the tax benefit was, how many wells are in it. There's a really extensive write-up on every single deal in there. And I would say even during these, we've been in a bear market for 2.5 years now. Our returns have been pretty decent through that time frame. Most of the project before that has paid out for 12 months, and I think it's sitting right at 38% over that time frame. So it's tracking in that area, but that was also, we've been sitting at, most of the oil over this last year was sold down in the 50s. So having $100 oil is significantly higher and will have a really great impact on returns. So it's a very different environment than what we've been through in this last couple of years.
Yeah. I myself, my first investment with Courtney was November of 2023, and oil prices weren't even as high as they are now. I think they started out at maybe $90 a barrel and they steadily decreased.
Yeah, they
Uh,
went from 90 to set. They went from 90 in November to 70 in December, and then literally went down from there.
yeah. And even on that investment, I myself, as a passive investor, made a 42% return in that first year, all of 2024. And once I saw that's when I started saying, hey, this makes a lot of sense for investors to invest into. I've seen it work for myself. And that's when December of 2024, after 1 year of investing, getting that 40% return, we started bringing it to our investors.
One question, can you talk about the cost basis on which this fund is buying the working interest? For example, I understand that Iron Horse 1 was bought when the price were 60 to 65, so we would expect to enjoy increased returns in the current landscape.
Yeah, and this is what I was talking about earlier in potentially not having a Q4 fund because the increase in oil prices have not impacted the acquisition prices yet. I am concerned that will happen down the road. So that is one of our things. We will always want a minimum of an 80% K1 benefit, and in order for that to happen, we need for it to be 20% or less for the acquisition price of the expected drilling costs. I won't get into that because that starts getting really complicated, but what our pricing has been keeps us at that 90% level. The acquisition prices at this point in time have not changed, but I am concerned that it will be impacted later down the road.
So
Good.
now's the time, best time.
The last one we have here, keep the questions coming. Can you walk through a simulation of a $100,000 investment made in June 2026? What does the estimated cash flow look like for the next 1 to 2 year period after accounting for fees? We did that, but do you want to go through that again?
That's in the calculator on the investor portal. So if you just go here where it says clivecapital.cashflowportal.com, there's a calculator in there for this deal, and you can see the annual breakdown of our projections. And there's
Yeah,
inputs. Go ahead.
and I just wanted to throw in too that there's going to be about a 6 month ramp up period. Some of the acquisitions, those wells are already about to come online and start producing. Some are still in that drilling process. So there's a few months in there of kind of ramp up as we're waiting on payments to start and things like that.
And the other thing I'll say is we invest into a lot of different things. We look at a lot of different deals, real estate, private lending, oil and gas. Pro formas make a lot of sense in real estate and private lending. It doesn't make as much sense in oil and gas because you don't know what the price of oil is going to do, what other countries are going to do in terms of reducing or increasing supply. So these are all, there's like a whole global macroeconomic situation that has to be accounted for. So there's projections, that's all they are. And it's like trying to nail them is like me trying to nail what the price of meta stock will be over the next 5 years. I don't know what that's going to be. I can generally predict where it's going to trend, but just keep that in mind for especially folks whose first time it is investing into oil and gas, that it's going to be a little bit of, but because of the fundamentals that we've mentioned, regardless, that's why it's a great investment.
It's a little different than real estate because it's not like we have 1,000 doors, here's our rent, here's our vacancy. We have a lot of factors that impact us that we don't have any control over, like the commodity price and how the wells produce when they come online, which is why we have very strict underwriting criteria so that we can mitigate as much of that as possible. We can't eliminate the risk altogether, but I do believe in the underwriting criteria we've built. And even through these bearish times and $50 oil, we still, with the exception of the one deal where we had to swap out the pumps and it was really expensive, we managed to continue to have distributions in every single one of our other projects.
Another question, should we consider the numbers and assumptions used in the calculator as being realistic, aggressive, or conservative in your view?
I
So
would say they're very conservative.
yeah, and the one we've talked about the most is the $72 per barrel of oil. And we mentioned that's the average price over the last 5 years, doesn't account for inflation. That counts COVID when prices were still pretty low. And we have this huge setup ahead of us here where oil prices will likely stay elevated for the next 1 to 2 years at least.
Yeah, and the other thing I'd like to add is we set that at 650,000 barrels per well. We have several wells that we acquired in our last fund that were expected to produce well over 1 million barrels. So not only do we have the oil price set, which you can change. If you want to see what the returns are at $60 oil, you can. If you want to see what the returns are at $100 oil, you can. I like to set it at 72 just because that's a really good longer time average. For this next year or two, it's definitely see what the returns look like by year. There's a tab on there that has the yearly income. It's good to see what the differences are.
The next two questions are related. Do you see any possibilities of capital call beyond initial investment? And then the related question is on the opportunity where the pumps failed, are there and needing to be replaced, was there a capital call for those investors?
So, those are actually really good questions. And one of the things that is very important for us is to never ask for investors to have to contribute a dollar after they've invested. And we never have. And so, the Colorado 3 project, very specifically, those pumps were about $750,000 a piece, and we had to replace four of them. And we own 10% of those wells. We had a pretty significant cost in that. And they don't say, oh, we'll let you make payments on that. So, we went in as the GPs and covered that cost so that there would not be a capital call for our investors. And one of the things that we have implemented in addition to that in these funds is a contingency fund of 5% that sits in a money market account bearing interest. That way, if there is some crazy thing that happens and there's costs that have to be paid, or let's say oil dipped down to $30 and stayed there, we can cover those monthly expenses without having investors come back and do that. And then at the end of the fund, we will take that contingency money along with the interest and return it back to the investors. But Rick and I, in our 20 years, I've only been doing this for about 5 years now. Rick's been doing it for 20. We've never had a capital call to our investors on any of the more than 180 deals.
That's great. One, there's a couple more questions. This investor doesn't see the Iron Horse Energy Fund 2 in the portal yet. Only one
It's
in the portal.
OG5. OG5
It's
is what
OG5,
you're
yeah.
looking for. Yeah.
Yeah. Okay, very good. And then if the break-even cost is 40, then I believe it means that if the oil price is 60, then it would be profiting $20 per barrel. Therefore, if oil prices are 100, is it correct that we would be profiting $60 per barrel? Therefore, near-term returns are 3x what they would be at 60. Does that math
That's a
out?
really good rough estimate. So obviously there's monthly operating expenses that have to be pulled out of that as well. And some of those operating expenses are fixed and some of them fluctuate with the price of oil. So some are fixed and some fluctuate. So it's not a one-to-one expanse, but it is significantly higher. Yes. And so that is a really good point. I'm glad that you brought that up because the returns and everything look very different at $100 oil. And yes, you're right on track with that, Mark. That was a great question.
The other thing that I'll mention also is if this fund starts producing income, which it should in Q4, and your original tax deduction was, let's say, 90%, because you made income on your K1, you might see that you can only claim 70% losses because you had income that was produced. And that's something that we ran into with our deal back in July of last year. Some investors were a little surprised. So that's just keep in mind that if you make income, then you won't be able to write off as much in 90%.
Yes, those taxes will start offsetting that income. Correct. Very good to
Okay.
point that out. Yes. We don't have that happen in the Q4 funds. It could potentially happen with this coming in earlier in the year, depending on when those projects start paying out.
The next question, there's two parts. The first part, I'm going to ask the second part first because it's easier. K1 timing, when did the K1s actually go out for your prior closings? Should I plan on federal state extensions every year? And is there an SLA you can commit to?
When did we put Iron Horse or OG4s out? I think it was like April 8th or something. We were cutting it close. I want to say it was the first week of April. I don't remember the exact date. We got the main Iron Horse K1s, I think on March 9th, and then we had to wait for the turnaround from the CPAs for the individual investors. And I want to say it was the first week of April.
Okay. And then is there a secondary market for investor shares in the project, it's unlikely someone would, if someone needed to exit early.
I would say there is not. We typically don't have a secondary market or a way to exit that. Obviously, I guess if something arises, reach out to us and we'll, at the end of the day, I see this as a partnership. And if there's a way we can work something out and figure it out, I'm always up for doing that. But I don't want to say, yes, we will do that. Our documents are written that there is not a way to exit that. But like I said, if some kind of extenuating circumstances arise, this is supposed to be something that we are all working to better all of ourselves and our lives, right? Reach out and we'll see what we can figure out if we can figure something out for sure.
I always, as with all investments, recommend that you invest money that you're fine not seeing for a couple years because it's going to take time for these investments to produce. Oil and gas is better than most investments. Real estate is very illiquid, and most of your returns are on the back end. But with oil and gas in year one, you're getting a 35% return through the tax savings. And we're projecting that you're going to make another 40% in year one. So by the end of year one, you're going to have 75% of your initial investment back through a combination of tax savings and the cash flow already. So while in other asset classes it makes sense to think about that, in oil and gas, because you're getting money back so quickly, your risk of having money locked up isn't as high because you're earning those dollars back at a rapid pace.
Great questions. I don't see any more questions. If anyone has any more questions, please insert them now. Otherwise, I think we're done.
Yeah, so that get on right at the top of the hour. Reach out with any questions that you have. I'll share my screen here again very briefly with our contact information. And okay, here we go. So this is our contact information. Feel free to reach out with any questions that you have, email, text, phone call, and please review the data room as well. And the portal link is here, clivecapital.cashflowportal.com. So we look forward to partnering with you on this investment. It's a great time to be investing into oil and gas because of the macroeconomic situation. And like we're saying, we don't even know if there will be a Q4 fund. Depends on what prices do. So we always recommend that you get in before the upside starts shrinking. So happy to answer any questions offline, and we're really excited to partner with you, help you get some tax benefits and cash flow.
Yes, thank y'all. It was really nice to be here and see some familiar names.
Yeah, thank you, Courtney, for joining us today. Thank you, John. Thank you, Alexis, even though you're not on camera. And thank you to everyone listening at home. We're excited to work with you. Have a good day.
Thanks, everyone.